There are many investors who say that big companies always do well, and all that we have to do is to sit tight. So, is this a reality or myth? So, let's examine this hypothesis, the truthfulness of this hypothesis, by looking at the index fund, that is Nifty 50. So, the data for Nifty 50 is not available on the NSE website, the historic one, its constituents and everything. Of course, the day change values are there, but not the constituents. So, I have just taken a Nifty index fund from one of the mutual fund houses. So essentially, this will be 99% directionally right because 1% of close to 1% of tracking error would be there. So if you look at it, some amount may be there in the cache, maybe this or else even before the deployment, or else sometimes it is a decimal point changes which will be there. So approximately, if you look at it, so more than 99% of it would be true. And I have taken the 10 years of data. So from 2016 to 2025, how these things have changed. And the other thing is like, this is for HDFC Bank. Previously, there was HDFC Limited as well. So after the merger in 22, from 22 onwards, so it's only the HDFC Bank which was in existence. So what I have done is like, even in the past years, I've just merged them. I've looked at their combined weightage here. The row twos and the row three, they indicate the churn which has happened. So for example, 2016 is the base year we have taken. So from 2016 to 2017, there was no change at all. The same companies were there. So from 2017 to 2019, nine companies were pushed out of the index and nine new companies were added. So for example, in this case, so it was these nine companies which were added to the index from Bajaj Finance onwards to Hindustan Petroleum. So right from Bajaj Finance onwards to Hindustan Petroleum. So that was nine companies which were removed from the index and it was added. So in 2019 there was one change, right? And that means from compared to 2016 there were 10 changes in the index. So in 2019, so the company added was Britannia. So until that time, Britannia was not part of the index. So in 2022, 2020, so it was five companies which were there was a change of five companies and taking overall number to 15. So similarly, I have done that analysis for each and every year. Finally, in year 2025, that is on in January, the churn was like three companies were three new entrants were there in the index, and overall the number of companies which got removed from the index over a 10-year horizon is like 22 companies. So the three companies which were added was last added was Trent, Bharat Electronics, and Shriram Finance. Right. So in 10 years time horizon, 22 of the 55 large cap companies, that is 44% of the companies were moved out of the Nifty 50. See, all this rebalancing is being done automatically by an index. But if an investor doesn't act and if he thinks that he or she will sit tight and wait out, and what if the person is having a higher amount of allocation into this 44% of companies? It's just time, obviously, your returns will go down. And the asset allocation, even though if you're having asset allocation in place, and even if you're taking the returns to be conservative, things may not work out. See, ideally, you want to buy a company which moves from a small cap or a mid cap to a large cap. That means the company is growing at a rapid pace and it will generate superior returns. In this case, the reverse is happening, right? If somebody is with those 44% of the companies, it is moving from being a large cap. Maybe it is going from 51 to 100th company. That is again still the large cap companies only. Or else it is moving from these to the mid cap or a small cap companies. That means you will be having a negative returns most likely, right? So now let's just look at the sectors, how they have changed. Say, for example, banking. So in 2016, it was at 29.78%. Even now it is around 29%. In between, it has gone up to as high as like 36% in 2019. So there were multiple sectors, right? So software is at something around 14%. So consumer non-durables. So it is around 10% only. So the petroleum products, if you look at it, it is at 8% now. So compared to 6% then. So the auto has decreased like in a big way from 10.10 around close to 11% to 7% now. In between, it was like around 6% only. So same is the every sector, like the finance sector has increased. This is more, it was due to the insurance companies which got added later, like HDFC Life and SBI Life. And then telecom sector is there, constructions and everything. So everywhere it is either this, there is an amount which is increasing or decreasing. So that way, what happens is, apart from this culling, there is one flaw which is there in the index investing. That is, the companies or the sector which are overvalued, they tend to get more funds compared to the sectors or else the companies which are undervalued. So ideally, the stock picking has to be done in a reverse manner, right? If you are the one who is picking an undervalued company with a higher growth rate, you will end up generating a higher return. One, due to the higher earnings growth. Two, to the stock re-rating, right? Otherwise, what happens is there is a derating, possibility of derating. Again, that's how the Sensex actually culls. So whenever there is a derating, right, when people in the active space start selling it, so the value of this company automatically gets decreased in the index. So ideally, if you are an investor who has time to research and pick stocks and rebalance this with the changing conditions, then you should definitely go ahead. Otherwise, go to an active fund manager who fits with your thinking and the asset allocation. In case you're not in a position to do both, or else you don't believe in the active fund management, should go with an index fund. And always remember, in order to do well in the equity markets, the two key ingredients are asset allocation and the time horizons. See, this video is for an educational purpose only. It is neither a recommendation to buy nor sell the asset class in discussion. Thank you.